Shut up and sit down.
Welcome back, everybody. Episode 52 of the Rebel Trading Group podcast, where every day we are helping you fight for your financial freedom. Every day, work towards your goal. My name is the Gluten-free Jason Bessing, and I'm running this one solo today. Mr. Nathan will sit today out. He's a busy man, no worries. I am going to take care of you. It is Wednesday, December 5th, 2018. We are rushing towards the end of the year. Markets were closed today to honor George H.W. Bush. I believe it was the funeral was today. Politics aside, very sad loss for the country. He was a leader of ours, whether you liked him or not. He did good things. He did bad things, just like every other president. He's a very charitable man. And it's very badass to have an aircraft carrier named after you while you're still alive. That's just badass. So rest in peace, H-dubs. Market was closed today, as I said, so I don't have any numbers for you. But I did want to just kind of get some content out there. We were struggling to do that for a while because, unfortunately, I was having some computer issues. I was having memory issues. I learned more about Macs than I cared to, but I finally got it fixed. It took hours and hours on chat with AppleCare and Apple support, so now that that's resolved, I'm going to bring it to you. So let's go ahead and jump into a little market terminology. We're here to learn. I'm always asked, I don't understand the stock market because of these terms, and it's mostly the words and the verbiage. And I tell people all the time, learning Wall Street is not hard. You have to get beyond all the verbiage. If you've ever played craps before, you understand the same thing. The 9, the Nina, the field, the yo, boxcars, snake eyes, horn high yo. You know all these, but all you're doing is betting the 11, the 7, the 2, the 3, the 12, the 9. It's just lingo. Even in The Big Short, he says, do you sound stupid? Good, because it's supposed to make you sound and feel stupid, like you don't know what you're talking about. So, that being said, today's market terminology is going to be growth stocks to play off of value stocks from last time. And if you go back and listen to episode 51, we talked to that value stocks are those big, humongous companies, those big name brand companies. Usually they've been around for years and years and years, and they don't really have the ability to grow. Think of Procter & Gamble, think of Coca-Cola. Do they have growth? Absolutely. Do they have growth potential? Absolutely, 100%. They can buy other companies. They can come out with new products, increase sales. Absolutely. But they're not going to be like Google, where they blow out earnings and then go up 14% in a day. Like, quite frankly, that's just not going to happen with these stocks. So those value stocks instead reward the shareholders with cash flows, usually through the form of dividends and stock buybacks. On the other side of the coin, you have your growth stocks. And these are names just like I said. Google is one. NVIDIA, a lot of the semiconductor companies. And these growth stocks, they don't pay a dividend. They usually aren't huge, big brand names. And they might even be small caps and mid to micro cap stocks. Technology stocks. Facebook. These stocks are purely 100% in growth potential, and you're looking for these companies to grow. You're not looking for a value play. You're not trying to get a dividend from them. You're not trying to derive income from them. You're hoping to buy them low and sell them really high. Maybe they'll get bought out one day, like when IBM bought Red Hat. You never know. Maybe they're going to get bought out. Maybe they're going to be the next Google. Or maybe they'll be the next leader in the crypto blockchain space. But those are growth stocks for you. And they're, like we talked about last time, there are hybrids of the two. There's your growth plus value. And a perfect example, in my opinion, would be Microsoft or Apple, because they pay dividend, they have strong cash flows. Not hugely overpriced, but still a little overpriced. But they have a lot of growth potential too. Apple has its driverless car unit, Microsoft getting into the blockchain world and the video game world. They're already dominating with their Xbox systems. So there are hybrids of the two, but it's on you to decide which one you prefer. Or maybe you prefer a blend of both. And that's going to segue me perfectly into today's topic, is identifying yourself as an investor or a trader. Once again, I get asked, well, what's a good stock to buy now? Well, what stocks do you like to buy? And my first question is, well, what kind of investor are you? And almost everybody that I give that retort to has no idea what kind of investor they are. So I'm going to give you a few questions that you can ask yourself to help you identify the type of investor that you are. And you can use that knowledge to start to acquire assets and put them in your portfolio and kind of make your own blend of this. Because everybody has a different style. Everybody has a different goal. Everybody has a different portfolio. And it's beautiful. That's the beautiful thing about this game. There's no one way to do it. There's millions upon millions, if not trillions of ways that you can allocate your portfolio. So let's start with some of the questions that you can ask yourself. First of all, what's your goal? This is probably your biggest one. A lot of people would say, I'm investing because I want to make money. Well, how much money are you trying to make? Because I can guarantee I can make a nickel. I can help you make a nickel in a few minutes. I don't know if you are trying to make $1 every month. Are you trying to make $100 a week? Are you trying to make $50,000 a year? Are you trying to build a nest egg for retirement? Are you trying to put a kid through college in 20 years? What are you trying to do? What is your goal? And that's going to be the first spot to start. You got to identify your goal. Think of a marathon or any sort of race. We always know how many laps there's going to be, or we know how the distance is going to be. You don't just sign up for a race and I don't know how long it is. We're just going to run until they tell us to stop. That would be a shitty race, and I don't think a lot of people would do it. So you've got to have the goal in mind. You've got to know what you're working for. Next question kind of goes with the first one. What's the time frame? If you're going to put your kid, if you're pregnant right now, congratulations, and you're going to put your kid through college in 18 years, well, you've got an 18-year time frame. But if you opened an IRA at 62 and you're trying to retire at 65, you got a 3-year time frame. You've got to know that time frame and how long it's going to take to that goal. Personally, right off the bat, I'm trying to get to $1 million. I don't know when, but at some point in my time frame, I have all the time in the world. I have 40 plus years. I have till the day that I die to keep this account going. Also with your time frame, you got to know when you're going to need the money. Are you saving to purchase a house in 5 years? Well, maybe the market isn't where you want to be, because if you're going to need that money in 5 years, you might not want to touch it. My rule is 3 years, but I'm a different case. I'm a little bit more aggressive than the rest of the people out there. So identify the time frame, identify how long you're going to need to lock your money away, identify those. Moving on, pressing forward. Third question, how active do you want to be? Do you want to be a high-flying day trader? Do you want to set it and forget it? Remember, there are 3 types of traders. We have the day trader, usually in and out of a position on the exact same day, within minutes, maybe a couple hours. Most day traders will never hold a security overnight. You have your swing trader. Usually will hold any time between a few days, up, I would even say almost a year, is a swing trader. Maybe you're looking for about a 10 to 15% move, a 7, 8% move. When a day trader's looking for 1 or 2% move, lock in your gains, run, go to the next best thing. And then last you have your investor. I like to say I'm a swing trading investor. Investor is anybody who's looking a year plus. Some people would disagree and say it's 5 years plus for an investor, but off the top of my head, if you have at least a year time frame before you enter and exit a security, you're going to be an investor. So how active do you want to be? Day traders, they have the potential to make lots of money, but they also have potential to lose lots of money. In fact, 95% of them do. That being said, The other 5%, they're very successful. They make a lot of money. They get to turn on CNBC. They get to kiss their kids before they get on the bus and go to school every morning. And they wake up, they open the markets on their E-Trade account, and from 9:30 to 4, they trade, they make money, pick up their kids from school, and they live the fucking dream. Okay? That being said, you literally have to quit your job. You either have to work nights somewhere or you have to quit your job because you need to be active throughout the day. Every single day, 9 to 5 on the computer, ready to move. If that doesn't sound like the lifestyle for you, check out swing trading. Maybe you're able to identify patterns on a chart over a longer time period. You want to buy here and maybe sell it here for a 5 to 6% gain in about, let's say 5 months or so. You're able to, Ford dropped to a pretty good value. I'm gonna buy some here and see if I can sell it on a nice pop up. That's a swing trading mentality. And the investor is, I'm going to put this money away, and in 20 years, it's going to double, or it's going to triple. So that kind of goes with identifying the time frame in which you need the money, but you also need to know how active you want to be, how proactive in your own personal financial management you wish to be. So we are swing traders and investors. I will do a day trade if all the conditions kind of work out. If I buy and it goes up 4% in a day, I'm going to go ahead and lock it in. I'm going to reevaluate, and I'm going to check back later. You need to know how active you want to be. If you're new, start with investing. Start with just your accumulating and watching how the stock market moves. And my fourth question here, what's your risk tolerance? The hardest thing for most traders to grasp is that you will lose money. 100%. I can guarantee you at some point you are going to lose money. And anyone that has told you that they never lost money is full of shit, and you should run. You will lose money. But it's on you to mitigate how much that's going to be. Are you going to lose 2% of your portfolio? Are you going to lose 0.5% of your portfolio? Do you have 30% of your portfolio in one option play? How risky are you? If you're able to watch your portfolio move 5-10% a week, you've got a pretty strong risk tolerance. But some people cannot stand the thought of losing more than 2%. So that's going to play into how diversified you want to be. Somebody who has a higher risk tolerance, maybe they don't want to be in 30 different stocks. Maybe they want to be more aggressive across 5 to 10 stocks. Maybe they want to play heavier technology stocks. XLK is the technology fund, and I think that's a great growth play for somebody who is an aggressive player and is looking with a 15-year outlook. 10-year outlook. XLK would be something like that. If you don't have the risk tolerance like myself, while I will take big bets, I like to take big bets on smaller movers, less volatile things like your blue chips and your dividend payers, utilities. Those are the things I like. I don't care about buying at 30 and selling in 60 in 2 weeks. That's not my game. That's not what I do. I prefer to buy at 30, collect a 5% dividend for 2 years, and then sell at 40. I think that's way better. It's way safer. You know what's going on with your account, and you're not having these massive 5 to 10% swings that are giving you stomach ulcers. So let's review those 4 questions. What is your goal? What are you trying to achieve? What's the time frame? When will you need this money? Do not put it into the stock market if you need it within 3 years. If you need the money within 3 years and you're looking for a way to grow it, we'll get to that in a different podcast, or you can email us, rebeltradinggroup@gmail.com. Alternatives to the stock market to get a guaranteed return. How active do you want to be? Is this something you want to check every day, every other day, every week, every month, every year? How active do you want to be? Do you want to set it and forget it? We did an episode on that. Set it and forget it investing. I've actually got my mom doing a little bit of that. How active do you want to be? And finally, what's your risk tolerance? Can you handle huge swings? If so, maybe you want to be aggressive in technology or real estate or maybe banking. You can get lots of yields. You can get very high yield, very good returns in sectors that are growth oriented. But if you have a lower risk tolerance, maybe you like gold, maybe you like commodities, maybe you like dividend payers, something that like housing REITs or utilities or consumer staples like Philip Morris or a Coca-Cola or a Unilever. Those are the things I like. And I do have a high tolerance of risk, but I am just about the value investing. So as you can see, the value investing comes in with the lower risk tolerance, the growth investing come pretty much with the higher risk tolerance. So those are just 4 questions I wanted everybody to ask themselves. And it never hurts, no matter how long you've been trading, weeks, months, days, years, decades, it never hurts because sometimes these answers will change. Sometimes your time frame will go from 20 years to, you know what, I'm going to use this money as a payment on a mortgage in 5 years. Well, now maybe you need to readjust your strategy to be a little less aggressive. You know? You need to ask yourselves these questions because things will change throughout your history. The reason why you do this every day is going to change. But you can adapt the portfolio to the situation, but you can't adapt the situation to the portfolio. So I wanted to put that out there today. Very simple, quick little episode here. I think it's a very useful one, though, especially for the newer traders, if you're newer into this. I'm going to go ahead and give you something that I'm watching. So the market was closed today, so nothing exciting happened today, obviously. One thing I am watching, though, I said it last time, and unfortunately I'm going to have to use it again. I continue to watch oil at these prices. And not so much oil itself. I'm watching how oil is pushing the energy markets. XLE is the sector for energy. Your ExxonMobil, Chevron, Shell, British Petroleum, what have you. Phillips 66. You know. We know that we are in a huge downtrend for oil, and it might have bottomed out at this 50 range. Popped up slightly earlier this week, but it could be a little dead cat bounce. So in the meantime, enjoy the prices at the pump, but watch XLE. It might set up a little bit of a buying opportunity. It's hard to buy stocks in this environment because a lot of things are on sale, especially a lot of those value names. I've seen a lot of dividends go into the 3 to 5, almost 6% range on some of my favorite stocks, my favorite blue chips too. So I'm going to continue to watch oil, but more specifically how oil is driving energy, because we know that energy companies, their profits rely on the price of oil. I've explained it before. If the price of oil goes up, it's not costing them more to get it out of the ground. That just means that the thing they're getting out of the ground is now worth more, and vice versa. So watch energy, XLE, watch WTI, crude oil, and I hope you were able to learn something today, or at least have a refresher. This is kind of one of those connect with yourself episodes, you know. So if you have any questions, comments, concerns, suggestions, you can email us. Once again, that's Rebel Trading Group with 2 G's, rebeltradinggroup@gmail.com. We are on Soundcloud. We're on Stock Twits. Get at us. We are on YouTube. We have a full archive of all of our videos. All 52 of them will be on YouTube for you forever for free. Okay? All right. We are going to be on Apple soon. We are going to be on Apple Podcasts. I submitted earlier. We're going to be up there. Hopefully, maybe we can get on Spotify as well. So, get at us. And final reminder, not a final reminder, but finally a reminder. If you have an idea for a logo, there is some money compensation in it for you. Over $150. If you can find something that encapsulates the rebel mentality behind our trading and why we do what we do. Remember, my mantra is every dollar we make, every dollar we scalp, and every dividend we get is one that a banker in Goldman Sachs did not. Okay? Every time you take a trade, there's an 80% chance a bank or a hedge fund was behind it. An institution was behind that trade. So go get yours. Go fucking get it. And if you can design a logo that encapsulates that, I'm going to buy it from you. And you will also have a credit in every single podcast that we do. Get out there, draw for us. One last thing, if you want to be on the show, we are looking for fellow traders. We want to learn about your strategies. We want you to teach us a few things. We just want to get that community of traders going, and we all have the same goal. We all are here to make money. Nobody is in the market to lose money. This isn't a casino. We're not going out and having fun. This isn't that. So, I love you guys. Episode 52. Hopefully we can get back to you by the end of the week. If not, we'll see you again on next Wednesday. Until then, everybody, happy trading, good luck, and may the volatility gods be ever in your favor. Good night, everybody.
Shut up and sit down.